Welcome to the daily update, where I'll go over the action in the market for Tuesday, February 27th, and then we'll see how things look for Wednesday, February 28th. Had a slight up day. On the positive side, you can say, well, okay, we're not really falling apart. We hit that upper resistance last Friday, and a lot of times when we're going to see a big reversal, it turns and goes in the other direction with a vengeance. We're just not seeing that right now. That could, of course, change at any time, but a lot of times when the market goes up to a high, turns, and then really is anticipating a reversal, we see that with a little more vengeance. In fact, any more vengeance than what we've been seeing now. We had another pretty quiet day in the session, not an awful lot happening. The market is anticipating the inflation information coming out later in the week. And so it's kind of still staying in that wait and see mode. So let's go back and talk about what happened. Right at the open, we did have a flat open, and this is the same statement I made after Monday's session. And prices remained flat. As the day went on, we drifted down. We were able to find support at S1 at 50.60. We climbed back up to the unchanged level and went positive, and we closed at the daily pivot at 50.79. We were up 0.17% on below average volume, so we're back to that scenario again. A slight update, a decrease in volume, but we did also see a decrease in volume in Monday's session. And we are positive with our technicals. We do have some extreme readings to the upside, suggesting that we may be overbought. There are some warning signs that we always want to pay attention to. But for right now, when you take everything together, we're still looking okay. And it's going to be about inflation and interest rates with the PCE report coming out later in the week. It seems like that's what the market's waiting for, because there's not a real catalyst right now to push prices either higher or lower. And for the time being, you can take that as more positive because we're not seeing an awful lot of selling. And of course, we want to keep an eye on the different geopolitical events. Some comments. This is kind of a surprise. Small caps actually outperformed yet again. Okay, they're getting a little bit of fire underneath them. It's almost March now, so much for the January effect, especially when we look at the tech sector inside of small caps. And I have a chart to show you that later. Our list is pretty short right now when we're looking at extreme positive readings. We do have a new addition what the Williams percent are. The CCI based on 14 periods has now fallen off. We still have the CCI 20 and our stochastics chart. In the intermediate term, the Arun really didn't change, but it's coming off of giving us an extreme positive reading. Keeping an eye on our oscillators, getting a little bit of a mixed picture there. The Sean trend meter. The boom indicator still suggesting that we're kind of far away from the 50-period moving average. And then our 10-period new high, new low study for the S&P. Long term, we're still looking extreme with the 150 and 200-period simple moving averages. The current scenario has not changed. It's likely that the Fed is done raising rates and that they're probably going to cut rates. We just don't know when. And the dollar was up. Interest rates were also up. We closed with the 10-year yield at 4.32%. The yield curves that we still follow remain inverted. Sentiment is still extreme at 78. We're above that 75 level, but we're really not starting to fall yet. Our trend really hasn't changed all that much. It's still positive. The green line's on top, but the ADX is still, they're kind of right on top of their moving averages right now. They're not necessarily crossing over to suggest that the trend is getting stronger. With the slight update, we're positive with our bias, and I'm still keeping our momentum at positive. We did get durable goods that came out as one of the economic reports. It was pretty weak, actually. It was down 6.1%. They had expected it to be down 4.4%. Last time it was down 0.3%. These are more big ticket items that last longer, and that could suggest a little bit of economic weakness. When you take out transportation, it was down 0.3%. They expected it to be up 0.3%. Last time it was down 0.1%. The FHFA housing price index was up 0.1%. Last time it was up 0.4%. The Case-Shiller home price index was up 6.1%, a little bit more than the 6% they had expected. Last time it was up 5.4%. And then consumer confidence. This came in a little weaker than expected at 106.7. They expected it to come in at 114.6. Last time it was at 110.9. So looking at some charts, this is a year over year look at durable goods where we are seeing a decline here and actually dropping below zero. When you take out aircraft, also dropping slightly now below zero. Durable goods on a month over month basis, we really saw a drop off here. And then when you look at this chart, the FHFA Housing Price Index, we're still going up with housing prices. But when you look at the Case-Shiller Price Index, we're actually seeing a bit of a decline here. So a little bit of a contradiction. Looking at consumer confidence, first we look at the blue line where it came down just a little bit. That's how the total reading came in. The purple line is how folks are feeling right now. That decreased a little bit, and we're seeing a little bit of less optimism going out into the future with expectations. Couple of charts here. This is just saying that the U.S. consumer is strong, where the global producer is weak. This is looking at the ISM manufacturing. And the reason I'm showing this chart is we're going to get this reading on Friday. Then we're comparing it with non-farm payrolls. We won't get that for another week yet with the employment situation report, but we're still seeing the employment situation strong. The manufacturing is still below 50. We're wondering if that's going to pull the ISM above 50. And then looking at the tech sector inside the small caps, and this has been a stronger area as far as performance. And then I just want to briefly go over this. I've been showing this in every video over the last few days. When the Fed cuts rates on a slower basis, that tends to be positive for the market. If they're cutting rates on a very fast basis, that's usually in response to some kind of very negative event that warrants the rates being cut, and that tends to be more negative. Here's our intraday chart. Man, we had a sleeper session on Monday, another sleeper session on Tuesday. We did come down to S1 here, but then we bounced up off of that, went positive, and closed right at the daily pivot. Here's our intraday chart. Not an awful lot really going on. The futures were slightly positive in the pre-market session, and we're up slightly in the initial overnight session. We're seeing growth in value pretty much on this chart anyway at about the same level, so we're not seeing much of a change there. And we are coming down just a little bit with our S&P growth to value ratio. It did end up declining just slightly. But when you take the last number or last couple of days here with the intraday chart, at least we're holding up for right now. We're not breaking to the downside, but at the same time, we're not really moving up higher. The end of day charts where we did have growth in value were up, but growth was up less. Also for the mid caps, it was up, but up less. And for the small caps, it was up, but up less. And so we're hanging in there for right now. When we look at the small cap growth to value ratio on the end of day chart, it actually ticked down just a little bit, but it has been breaking out lately. We're seeing it a little bit better here with the mid caps, but not breaking out above these previous highs. And with the S&P growth to value ratio, it declined a little bit and kind of back toward these higher levels that we were at before. We are seeing a golden cross now with this ratio. And discretionary, still hanging in there. We're actually breaking out a little bit when you look at discretionary by itself, but we did see a little bit of an improvement with staples, so the ratio isn't really breaking out now. But this could be encouraging. If we're starting to see some strength in discretionary, that would help the overall market. Keeping an eye on our trend, we're still below the moving average with our intermediate term ADX. The green line is on top. It's declining, but it's still above 40. Short term, also green line on top, still above 40, right on top of the moving average. Volume continues to drop off. And sentiment, we're not really changing all that much with the Ulcer Index. We did decline with the VIX when we look at the line chart as well as the bar chart. So fear is not really increasing, at least yet. We're seeing volatility really dropping off as well. The VIX of the VIX continues to fall well below the moving averages. And even the momentum of the VIX is starting to roll over now. Since the first part of December, we've been seeing the VIX, for the most part, going up. Now it's rolling below its moving average. We don't know if this is just an anomaly before it gets set to turn and go back up. This may continue to go down, which is typically more positive for the market. Our one-day equity put call ratio did decline, but we're still going up with our 5-day measure of the equity put call ratio. That's still more negative. And we're down below this dashed line now with the VIX to S&P 500 correlation. Is this a final spike? Have we come down? Okay, we're not really seeing the market dealing with this all that much as far as the price action. And then we will get a new reading here with Investors Intelligence. It's still looking extreme positive. It's probably going to remain extreme positive based on the other indicators that we look at that change each day. With the advanced decline ratio, we did show a little bit of an improvement, and we're still not breaking out here when we look at the advance based on volume. That's a little bit of a negative divergence. And we're seeing a drop off in the new highs, but they're still way outnumbering any kind of new lows. So we're still having a tendency to go with our 5 period and our 10 period. We're still above zero with the advanced decline ratio. Accumulation distribution did turn back up slightly. That's still looking good. We're still declining with the chicken money flow, but we're still looking quite positive there. And we're continuing to decline with the chicken oscillator. Not any real big changes here with our advanced decline line studies. A little bit of an improvement for the NYSE common stock. Turned up barely with the S&P. A little bit of an improvement with the mid caps, but not breaking out. And a little bit more of an improvement with the small caps, but still having a lot of damage to repair. Here's our daily chart. We're still above this trend line, so that's holding up for right now. On the bottom, we still see where volume is dropping off. We're keeping an eye on the 20-period moving average. If we start to see some downward movement, we'll be watching this, especially if we break below the trend line. And here's the Williams percent R, which is just barely extreme positive. The CCI 20 is declining, but it's still extreme positive. We ticked up a little bit with the 20, 50, and 200 period moving averages. We're still looking okay. We're above the midpoint with the force index, even though it declined slightly, but this is still positive. We're going back up in the short-term stochastics, rolling over, but still extreme in the intermediate short term, and going sideways and extreme in the long short-term stochastics chart. We're not looking extreme right now. We're up at the upper end of the +2 channel with our standard deviations chart. The balance of power did decline, but we're still above the midpoint. We're still looking positive here with the go, no-go system with the darker blue bars. And we're above the midpoint and just coming off of the highest high value here. So that's positive. The TTM squeeze shifted back to a lighter shade of blue. So that's turning a little bit more positive. And we're not extreme with our 20-period boom indicator, but we're still extreme with the 50. We're still showing some improvement with the 200. And we actually declined, but we're still positive with the ease of movement. We're still going down just a little bit with the Arun indicator after giving us an extreme positive reading. We're above zero and ticked up just a little bit with the McClellan oscillator for the S&P. So we're starting to go back up based on price as well as volume. And with the NYSE McClellan oscillator, we did tick back above the zero line. So that's turning our summation index based on price up a little bit for the NYSE as well as volume. So we're hanging in there for right now with the market overall. The Swenlin trading oscillator based on price and volume did advance and they're above zero. This is where we're seeing some choppiness with the PMO. It's pretty much right back on top of its moving average. We're going up based on price. We're flat when we compare this to volume. We saw a little bit of a tick up with the PMOs that are rising, a little bit of a turn up with the buy signals, and starting to turn back up slightly with the PMOs above zero. We still remain neutral for the Elder's Impulse system for the S&P. We still remain positive with the parabolic SAR. The slope is kind of right on top of its moving average, but trying to look a little more positive, but we're above this green line. So that's giving us an extreme positive reading. The MACD is still right on top of its moving average. So we are looking more positive here, but we're looking extreme positive with our oscillators, and we're pretty much right on top of the moving averages here. Longer term, we're just seeing where the moving average and the indicator itself, they're just right on top of each other as the market's really indecisive right now. We're still above all of the moving averages in our moving average tree. This is more positive. We did tick back up a little bit with the bullish percent index after we had been declining, and we're not necessarily extreme currently. We ticked back up with the NYSE bullish percent index. We were pretty much flat with the NASDAQ 100 bullish percent index. We're declining, but still above 50 with the money flow. And we're also declining with the ultimate oscillator, but still above 50. The vortex does show the green line declining, but it's still on top. And when we look at the RSI based on 14 and 9 periods, most of the recent prices have been above 50, so that is positive overall. On balance, volume continues to be positive. We're going back up a little bit with the stocks inside the S&P above their 20-period moving averages, but longer term, we're still seeing this negative divergence. And we're seeing that same thing with the 200-period moving average steady and the 50-period moving average steady. We're still negative with the Copic curve. We're coming down after being extreme with the Sean trend meter. And we're not quite back yet to setting an all-time high with the NASDAQ, where we did set a recent all-time high with the S&P. This would help confirm things if the NASDAQ could set another new all-time high. When we look at the chart, we're seeing more of a doji with this candle right now. The open and the close are pretty much at the same point, just suggesting that the market's really not moving right now. The KEGI is still positive, but now it's pointing down. The Renko chart is just staying the same, and the 3-line break is still looking positive. Long term, we came down to this trend line, but so far this level is holding, and we were able to close back up above that. And here's the long-term chart that we really noticed last Friday. We came right up to this pivot point. That was at 51.11. That was the high, and we have been falling back since that time. If we really start moving to the upside, we're still going to keep an eye on this level. Or has the high been put in and we're going to see a decline from here? That's what we're trying to figure out right now. And then longer term, we still have our 150 and 200 period moving averages that are extreme positive. We're still positive with the Keller market model when we look at the different indexes. And we saw mostly positive things with the alerts that were triggered, except there was a time when the Dow crossed below 39,000. Total stocks still suggesting that it's not only the Magnificent Seven that are leading things higher. We didn't set a new all-time high here, but this has still been going up lately. The equal weight and the S&P, the equal weight actually outperformed slightly. So we saw our ratio coming down just a little bit when we compare the S&P weighted index with the equal weight index. The Dow is still hanging out above this pivot point, and it was down. It switched back over to neutral for the diamonds with the Elder's Impulse system, and we're chopping more or less sideways with the NASDAQ. We're also chopping sideways with the NASDAQ 100. We still remain positive with the QQQs. The momentum for the NASDAQ 100 is flattening out here, but still below its moving average. So we would still count that as negative. And this is another longer term chart that we're looking at. We're right back up to this ratio when we look at the NASDAQ 100 and the Dow. We're wondering, is this going to pose some kind of a problem? Have we topped out? Are we going to start to go down? Or will we see some strength and be able to break through and set a new high with this ratio? The small caps were up 0.8%, but lately for them, that's kind of a big move. They're still above their 50-period moving average, but really choppy lately. And they've remained at positive with the Elder's Impulse system when looking at the small caps. Also, the Russell 2000, we're above 50 and advancing with the RSI. We're still above this support level. We're above the 50-period moving average. The longer-term trend is still positive, and we're turning back up with the momentum when looking at the MACD. The mid-caps also up a little less than 0.5% and still above this pivot level. And we've switched from being neutral over to positive with the mid-caps when looking at the Elder's Impulse system, chopping more or less sideways with the FANG index right now. The financial sector up a little more than 0.25% and still in an uptrend. New York Community Bank was up and is kind of settled in around the 4.5 to slightly above that level. The dollar ended up being up. We're still above both of the moving averages, and it's pretty much been bouncing since the beginning of 2024, which at some point could put some pressure on stocks if it keeps going up. We were up with the 10-year yield. We were down with the 10-year based on price. And then looking at growth of value, we're right back up to the moving average when we look at the Qs versus the S&P. We saw a little bit of a move above the moving average with discretionary to S&P. That could be encouraging, but discretionary really needs to kick into gear if this is going to turn into something. And we're still above the moving average when we compare large cap growth with large cap value. So with the large caps, mid caps, and small caps, we're still above the moving averages. We're still looking positive with our 5-period highs minus the lows and spread out across the broad market. We're still looking extreme positive with our 10-day average of the highs minus the lows for the S&P. So what's our outlook for Wednesday? This is still the same. I really haven't changed it. We're positive for right now, and things are still holding up. We're slightly overbought. We do have that overhead resistance on that longer-term pivot point. Weakness could still be developing, kind of went away a little bit in Tuesday's session, and we're dealing with a period of historical weak seasonality. We're going to get the MBA Mortgage Applications Index, the second estimate for GDP, which may be a non-event if it comes in the same as the first reading. If it's drastically different, that could have an impact on things. And we're going to get the Advanced International Trade in Goods, as well as retail sales and wholesale inventories. Not a big market mover there. And then we want to keep an eye on the geopolitical events. So in Thursday's session, that's when the PCE report is going to come out, and that's a big one. And then we're going to get ISM on Friday, as well as consumer sentiment. Seasonality for February 28th, we're looking neutral to positive with the Dow, neutral to negative with the Dow, neutral to positive with the S&P, and flat out positive for the NASDAQ. And this is that kind of bouncy time that we're getting into as we get into the latter days of February. And then this also can carry off into March as well, seeing some more seasonal weakness. This is a new chart put out by Carson, where now they're not just taking January, but January and February. When they both end up being up, that tends to bode well for the rest of the year. And this really hasn't been all that helpful to us lately. We're just seeing a lot of choppiness, possibly some weak areas that we're in right now, according to the Stock Traders Almanac. Also, I tried to update this with the purple line, where we do see some seasonal weakness when the current president is running for re-election. And now I'm starting to include March, because February is the worst of the 6 best months. Then we start to move into March, which may have a nice little bump at the beginning, but then some weakness, and then tends to finish strong. It's like, March comes in like a lion and out like a lamb. And then Wednesday is the most negative day of the week. So we want to be aware of that. At least that's how it acted in 2023. We'll be on the 19th trading day of the month, where we do see some negative seasonality here, especially during an election year. And then Tom Bowley still suggests his research is looking pretty weak going into the end of the month. Then looking ahead at March, where the S&P is up 11 times during an election year out of 18, where it's down 7 out of 18 times. The average return is 0.4%. And then looking at the statistics going from 1950 to 2023, where we're up 64.9% of the time, and the average return is 1.1%. So, can we really go with the down scenario? No, things are still looking pretty positive for right now. Logic may dictate, we hit that resistance, we're going to turn and burn to the downside, but it's just not happening yet. But at the same time, we're not seeing an awful lot of follow-through buying. And then, but if anything, we would go with the up scenario, because our charts are still looking more positive right now, but we want to see some strength, especially going into the close. We're not going with the sideways trend, even though it suggests that we're seeing a weakening trend. We are still in a trending environment. The green line is on top, so we would default to positive. The warning signs, and we're still kind of dealing with this same basic scenario, where volume has usually been decreasing as the S&P goes up. The equity put call ratio is going up. That's negative. And then I just went ahead and made a list of negative divergences here. The S&P 500 oscillators, the McClellan oscillators, as well as the summation indexes, the S&P, the small caps and mid caps to the S&P, discretionary to the S&P, transports to the Dow and S&P. The Copic curve is negative. The NASDAQ 100 bullish percent index is still below 70. The overall momentum for the NASDAQ 100 is still negative. And then we're possibly in this time of weak seasonality. On the positive side, we're still seeing growth holding up for right now. The parabolic SAR is positive. The oscillators, they're extreme positive, but they are positive, and that's positive in and of itself. The vortex is positive. Small and mid cap growth is still continuing to be positive and holding up so far. And the financial sector continues to be positive. So, our conclusion, this is the same. We're positive, yet there are some overbought conditions that we have. We do have some overhead resistance at that 5111 level. Weakness could still be developing, and we're possibly in a period of weak seasonality. That's what we're watching in the short term. Intermediate term, we're still looking at more of an overbought or extreme positive condition. We want to see if weakness continues to develop. And we also, of course, have overhead resistance. And we're still looking overbought in the long term with that 150 and 200-day moving average. Both of those are still extreme positive. Thank you. I really hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.